Bank stocks have been struggling a bit as of late, down almost 5% for the year, while the S&P 500 is up more than 7%. Our next guest says that while the revenue picture looks weak for banks, he believes a number of factors will push these stocks into a rally. Charles Peabody is an analyst and the partner in charge of research at Portales Partners. He's a veteran Wall Street analyst, has been named to the Institutional Investor All-American Research Team. Welcome to Bloomberg News. Good to have you on.
Thank you.
What are some of the factors that may push this?
Well, I think there are three variables that we see hitting in 2011. The first is revenue rejuvenation. Second is further reserve releases as credit quality improves. And the third is the start of the return of excess capital to the shareholder.
Where does the revenue rejuvenation come from?
Two fronts. We think we're going to start to see loan demand, particularly on the commercial side, emerge here in the fourth quarter. And the next year, we'll start to see some better consumer loan growth, strictly from the fact that charge-offs will have peaked and they've been hiding the underlying consumer growth. But the commercial side will drive most of it. And secondly, we think there's a second leg to the capital markets boom. This time will be driven more by M&A and equity.
Now, when you talk about the loan growth and you say loan demand may be coming back, of course, the sort of slowdown in lending that we have seen now comes from two sides. There's a lack of demand on the one hand, but there's also a lack of willingness on the part of the banks. What is going to make that willingness come back?
Well, I think the willingness will come back as credit quality improves. Today, I don't know if you reported, but we had the shared national credit exam, and criticized assets, which are the bad loans, were down 30% year over year in that shared national credit exam. That's mostly focused on corporate credits. So as corporations feel more comfortable, or banks feel more comfortable with their corporate credit quality, they're going to release reserves and they're going to make more loans.
You're expecting to see top-line revenue pick up. How much of an increase in loan demand are we going to see then?
Well, I think we'll be lucky if we see mid-single digits. But if you couple that with margin stability or actual margin improvement, because you're getting a better mix of assets, your top-line revenue growth could rise faster than mid-single digits next year. And that would be very healthy.
Of course, you know, something that could throw a wrench into all of this, if indeed we do have the double dip that at least some folks are expecting. I mean, I know you're not an economist, you come at it more as an analyst, but how big of a risk is that? Because that obviously plays a big role when you're talking about these other factors like loan demand.
If we have a double dip, we're not going to see any revival in loan demand. You're not going to get reserve releases. We're not forecasting that. We think, you know, we can get that low 1 to 2.5% GDP growth. And we don't think we're going to get a double dip in housing either, although we are expecting some weakness in the fall.
Capital markets, you're going to see them do better. Is that mainly, we were talking about M&A a lot before you got here today, equity's going to drive that as well?
Yeah, I mean, on the M&A cycle, usually it's a 2 to 3 year down cycle, and then you start to get some pretty big jumps. This is our third year of down. And on the equity side, we think we're going to have the earnings to support a better stock market, and that we'll start to see equity offerings pick up.
Charles Peabody, Portales Research, joining us today. Good to have you on. Thanks so much. We appreciate you coming in.